Hi, welcome back. In this session, I'd like to talk about and start on the discussion of the first set of investment philosophies, which are all built on looking at past prices and taking advantage of them. Along the way, we'll run into charting and technical analysis, and we look at what drives many of these, which is momentum and the basis for that momentum. To get this process started, I'd like to start with what finance or traditional finance would offer as the counter to looking at past prices, which is called the random walk hypothesis. Saying, what the heck is a random walk hypothesis? The random walk hypothesis argues that in the next instant for any stock, prices are just as likely to go up as down, that there are no patterns in stock prices. That might sound absurd to you, but let's look at the basis for the random walk, and then we can look at why it might not hold in the real world. It starts with the presumption that all information about the firm is publicly available and traded on. Investors get that information, they form expectations, and if they're rational, these expectations are unbiased. You know what I mean by unbiased, right? They're not set too high, they're not set too low. Prices react accordingly, so the price reflects those unbiased expectations, and then investors are not able to make money on those expectations. A new piece of information comes in. Remember, the existing price reflects what's known about the company. The next piece of information is then just as likely to be good or bad news. So the 50% chance of good news, a 50% chance of bad news. The price change then reflects that incremental information. And because the information is half good, half bad, the price change is just as likely to be up as it is down. That is the random walk, that in any given moment, the next piece, the next moment, stock prices or a stock is just as likely to go up or down, which means no matter what the historical price path is, there's nothing you learn by looking at it. That's a random walk hypothesis, and the reasons it might not hold. First is that investors are not always rational about setting expectations. So even if you start with the assumption that information is public and everybody has it, investors looking at that information are not always rational. Sometimes they're biased upwards, sometimes they're biased downward. The minute you introduce bias into expectations, the random walk starts to break down. Because if you're biased in expectations, you're over optimistic, for instance, then the next piece of information is more likely to contain bad news than good news because you've set your expectations too high. If you're over pessimistic, the reverse happens. The next piece of information is more likely to be good news than bad news. And already you can see one reason why random walks might break down. Second, price changes themselves might be information. In other words, investors in addition looking at information on earnings and cash flows and whatever else getting about the company, might be looking at what other investors are doing. So if they're buying, that might be viewed as good news, which in effect can lead the next price change to be affected by the last one. So not everything moves in a random walk, and that's at the basis for much of charting and technical analysis. People have used price charts and price patterns for as long as we've had financial markets. And one of the ways to start thinking about price charts and price patterns is to go back to your statistics class. In a random walk, price changes are uncorrelated. What does that mean? What happens in the next period has nothing to do with what happened in previous periods. If you're a momentum investor, you believe that price changes are positively correlated. What does that mean? If price changes have been positive for the last few periods, the next price change is more likely to be positive than negative. If you're a reversal investor, you think price changes are more likely to be negatively correlated. In other words, if prices went up in the last week, they're more likely to go down. So correlation becomes the statistical device we can use to separate momentum from reversal and bringing in random walk in the middle where the correlation is zero. If you look at the studies that have looked at price change correlation across time, you can classify them into four groups. In recent years, as we've had more data on intraday price changes, studies have focused on minutes and hours. Does knowing what happened in the last minute, the last second, help you predict the price change in the next minute, the next second? The short term could be days and weeks. Is there knowing what happened yesterday help you predict what will happen to stock prices today? Is knowing what happened last week help you predict price changes next week? Those are the short term. The medium term is months. Is knowing what happened to a stock in the last 6 months, the last year, help you predict what will happen in the next 6 months or the next year? And the long term, where is knowing what's happened to a stock in the last 5 years help you in making a prediction of what will happen in the next 5 years. With all of these studies, we're going to use correlation as a common language. When you start with the really short-term minutes or hours, there are two dwelling effects pushing in opposite directions. There's a market liquidity effect. If markets are not liquid, it induces serial correlation that's positive. And here's why. If markets are not liquid and good news comes out, a stock price goes up, it takes a while for that information to play through. So you might have over the next minutes or even the next hours increasing prices. If bad news, the reverse happens. So liquidity creates positive serial correlation in returns. At the same time, you got the bid-ask spread. And if you remember the bid-ask spread, the bid and the ask prices at any point in time capture the difference in price between trying to buy the stock and sell the stock. To the extent that trades zigzag between buys and sells, you can have a bounce between the bid price and the ask price. So you start ask bid. That's going to create negative correlation because you're moving back and forth between the bid-ask spread. In fact, there's a paper that actually estimates how much the bid-ask spread is by computing the negative correlation in very short-term stock prices. So two effects pushing in opposite directions. A liquidity effect creating positive serial correlation, a bid-ask spread creating negative serial correlation. Before you get too excited though, these correlations are really, really tiny and they don't last very long. So to be able to take advantage of them, you got to be able to trade almost instantaneously and on scale. You got to do it not in $1,000, but tens of thousands, tens of millions of dollars. There's a segment of trading called high frequency trading. We'll talk about this later in a different context, where computers were put to play trying to take advantage of the serial correlation by big institutional investors, and for a while it did make money for them. But the problem is it gets imitated quickly. High frequency trading made money for a few months, perhaps even a few years before other people brought in their own computers. And once you start to do that, the excess returns go away. So in the really short term, there is evidence of correlation, but it's small. And unless you can do it on speed and scale, very difficult to take advantage of. And even with speed and scale, not a source of excess returns for the long term. What about in days and perhaps even weeks? There is some serial correlation in daily returns, but it's really small and not easily exploited. In fact, the early studies found some evidence of correlation. Some found positive serial correlation, some found negative. But they're all small enough that you can say statistically there's correlation, but I can't make money on it. In fact, when more recent studies come back with findings that push in both directions again, you're going to find this a common theme when you look at price-based correlation. Studies push in both directions. With high volume stocks, there's some evidence of reversal, negative serial correlation over short periods. With low volume stocks, there's more evidence of positive serial correlation. And none of these studies find serial correlations that are large enough for you to be able to exploit to make money. So in the really short term, you've got this mix of negative and positive. The short term, you again have this mix, and in both cases, very difficult to take advantage of to make excess returns. You're saying, what happens if I go from days to months? Here there is evidence of correlation that's more significant, larger, more positive serial correlation. And it does look, at least on paper, that you can take advantage of this. One of the more famous studies of this was by Jagadish and Titman, where they found price momentum in returns over 6 months. If you took the stocks that have gone down the most, have gone up the most over the last 6 months, they're more likely to continue to go up over the next 6 months. Gone down the most, they're more likely to go down. So there's continuation of what's happened in the past. And they found, at least based on, again, on paper, that if you invested on this momentum effect, you'd have made 16.5% higher returns than somebody who invested in those stocks in the bottom decile. So the top decile of momentum versus the bottom decile. That's large enough to make a difference, and you can see it show up here. In fact, these are the returns on 10 classes of stocks based on momentum, where you're looking at momentum over the last year. And this is from Ken French's very useful database at Dartmouth, updated through 2024. So what I've done in this is looked at the returns you could have made on average for each of the momentum classes, from lowest momentum to highest momentum. Highest momentum are the stocks which did the best last year. The lowest momentum are the stocks that did the worst. And you can see there is some evidence of a difference in returns, almost a 10% difference in the lowest and the highest. And the excess returns reflect it. So at least on paper, it looks like there's enough momentum in medium-term returns, 6 months, a year, for you to be able to take advantage of to make money. And if you look at that momentum more closely and look across stocks, here are the things that people have discovered in different studies. First, they find that momentum accompanied by higher trading volume is stronger and more sustained than momentum with low trading volume. Momentum at small companies is stronger than momentum at large companies. On upside versus downside momentum, it's a split effect depending on the time period you look at. If you look at the entire time period, upside momentum dominates, but there have been sub-periods where downside momentum has won out. And finally, momentum tends to be stronger and more sustained at high growth companies than at mature companies. So if there's a hopeful theme here for traders, it is that at least over months or even 1 year periods, there is momentum. And that momentum can make you money, enough money to cover your transactions costs and trading costs. Maybe that explains why there are so many people who trade rather than invest. What happens if you go from 6 months or a year to 5 years or 10 years, really long term? Here you get a flip. That positive serial correlation you saw with 6-month returns or 1 year returns becomes a negative serial correlation. So if you look at 5-year periods and you look at the stocks that have done the best over the last 5 years, they're more likely to be the worst performers over the next 5 years. And the worst performing stocks of the last 5 years tend to become the best performing stocks over the next 5 years. Over the really long term, it looks like negative correlation is bad. So here's the bottom line on correlation. If you look at, at high momentum versus low momentum stocks, it varies by year. You're winning years, losing years, and that's something to factor in. There's no consistent winning strategy with momentum because it looks like it goes through phases where it wins a lot and phases where it doesn't work at all. Something to factor in. Overall, though, when you get extreme momentum, you get what people call bubbles. I know people are quick to label almost everything a bubble. But if you have momentum in one direction for really long, you have essentially a really big momentum drive, and there's a correction. That correction is going to be large as well, and that's that has often become the basis for price bubbles. The .com bubble, the social media bubble, now the AI bubble. One of the problems I have with that word is it already is quick to classify this as irrational. And I'm going to argue that it's very difficult to actually differentiate between what I call a blooper, which is a mistake that markets make all the time, and a bubble. Rational markets can make mistakes. So in hindsight, you might look at something and say, that looks like a bubble, but it might be entirely rational. A bubble is a willful error where you override information and you choose to push prices up. So the question is, how do you draw the line? And I think it's really difficult to do. In hindsight, you might say that was an obvious bubble. But let me give you a couple examples. Take gold prices between 1970 and 86. Gold prices soared in the latter half of the 1970s. Why did they soar? Because inflation was high. Now, if you look at gold prices by the time you get to 1986, it looks like a classic bubble, right? The gold price went up, then it went back down. You're saying, this is not, but was it? In 1979, there was a very real chance that we might not bring inflation under control. Remember, it took Paul Volcker and a 3-year recession to bring inflation under control. So what you have in hindsight might look like a bubble, but it might actually just be a market making a judgment about the future, and that judgment turns out to be wrong. Doesn't make it a bubble. In contrast, if you look at the NASDAQ between 1994 and 2001, there's much better evidence here that this was a bubble in hindsight, that there wasn't, a basis for the push-up you saw. But as I said, drawing that line between a blooper and a bubble is really difficult to do. So with that long lead in, let's talk a little bit more about bubbles, because this is momentum on steroids, right? Every bubble has four phases. There's the formation of the bubble, what causes the bubble to come together. Second, there's a sustenance of the bubble. There are things that are feed into keeping the bubble and making it bigger. There's the bursting of the bubble, and then there's the aftermath of the bubble. Every bubble shares these four phases, but no two bubbles are exactly the same, or even close to being the same, which is one reason, even if you've lived through the dot-com bubble, it doesn't give you any additional ammunition when you hit the next bubble. If you think AI is a bubble, it doesn't help you that you were there for the dot-com bubble. So let's talk a little bit about what is it that creates and sustains a bubble. Every bubble starts with a kernel of truth, a reality that just gets magnified perhaps more than it should be, but there's a kernel of truth. Let's go back to the dot-com bubble, right? The kernel of truth there was the internet was changing the way we live, we work, we interact. That was true. People overdid it, but there's a kernel of truth. That kernel of truth leads to there's a fear of missing out. So you invest in companies that are in that space, and then news about how much money you're making gets out. Other people come in and imitate what you do, and the bubble gets bigger and bigger. Now you can take whatever bubble you're familiar with, and this process plays through, right? Kernel of truth, initial winners, other people watching the winners coming in, and the crowd gets bigger and the bubble gets bigger. But bubbles would never get as big as they do without an ecosystem feeding them on. And here's the ecosystem. When you have a bubble, there are people who make money in the bubble. It could be academics writing research papers. Maybe they're not the biggest, But in terms of the people who make money, it'd be investment bankers, consultants, brokers, portfolio managers. And they now have a vested interest in not only preserving the bubble, but making it bigger. And they get intellectual support from those academics and intellectuals who give them a way of justifying the bubble to, I wouldn't say the word suckers because it sounds like I'm insulting people, but investors who are not in the bubble yet to try to get them in. So there is the sustenance of the bubble, and every bubble has this ecosystem that feeds into it and sustains it. Eventually, though, every bubble bursts. What causes it? I don't know. Because each bubble seems to be triggered. It's not usually there isn't a single precipitating event. A day we all wake up and say, oh my God, that was a bubble. It seems to be a collection of small cuts. But there are two things that I think that cause a bubble to burst. One is a bubble needs new investors, new funding coming in constantly. So like a Ponzi scheme, which is a scam, a bubble might not be a scam. Without new investors coming in, it runs out of oxygen. That's the first problem. The second is there's overreach. There's a point in every bubble where you start to see overreach. People coming in or companies coming in trying to get listened say, no way, that can't be right. Those of you who lived through the dot-com bubble, you saw those companies, especially towards the end of the bubble, you said, clearly we're reaching the end of our tether. These are companies that are overreaching. And when that first hint of doubt grows in, people push it away. But there's a triggering point where once people start to panic, it becomes a full-blown rush for the exits. And that's what causes bubbles to burst. But because the precipitating factors are so difficult to identify, it's difficult to forecast when that'll be. You're saying, but Alan Greenspan forecasted the bursting of the dot-com bubble. Alan Greenspan famously, who's the Federal Reserve Chair, described the dot-com bubble as irrational exuberance. You're saying, that is good. He saw what was coming. He made that statement in 1996. You know when the bubble burst? 2001. Eventually, everybody looks like a market expert if I give you 5 years to be right. So it is, no bubbles burst. We don't know what causes them to burst or what the precipitating factor is. Along the way, though, I would argue that much as people look back at bubbles and say, never again, that's a terrible thing, I argue that bubbles are a feature of markets, not a bug, especially when you have big markets that are still forming. I call this the big market delusion. And here's how it starts. It starts with a big market. It could be China, it could be AI, it could be .com. And when you have a big market, it attracts people who want to make money in the market, entrepreneurs, who tend to be overconfident people who think they can conquer the market. So you're an overconfident entrepreneur who attracts venture capitalists, tend to be overconfident people think they've picked a winner and they're going after the big market. You're saying, why do you keep introducing overconfident into your story? What does overconfident mean? They overestimate their chances of winning. They overestimate how much revenues they can make. They overvalue their company. And there are 100 clusters just like yours of overconfident entrepreneurs surrounded by overconfident VCs thinking that they can conquer this market. If you add up the values of all 100 companies, given the overconfidence, the sum of the values is going to be too high. The market they're going after is not large enough to sustain all of them. But initially you don't know, it's still unformed. You don't have that evidence. Eventually though, as the data comes in, the correction kicks in. I've given you 3 examples of booms and busts. You've got the .com boom and bust. You've got the online ad market in 2015, where I took every publicly traded company in the online ad business, estimated what they would need as revenues to justify the market cap, and added up all those revenues you would need and said, the overall advertising market is not big enough to sustain all of these companies. And a correction ensued. There was a cleaning up phase. Same thing with cannabis stocks. Initially when they came out, people were just excited. This is going to be the next great business. And it very quickly cleaned up again. Now, while people often look at these bubbles and say never again, they want regulatory protection against them, this is again a feature of big markets. And much as we don't like the damage that comes from the bursting of the bubble, it changes the way we live, right? That .com bubble, even though it burst, changed the way we live. The online advertising market might clean up, but ultimately we're getting most of our ads online. That cannabis market might have cleansed itself, but more people are smoking cannabis than ever before. So much as we look at these bubbles and bursts as bad things, they change the way we live, and it's human nature. We overreach, we correct, and we overreach again. So much as we want to classify bubbles as a bad thing, as irrational, it might be part and parcel of how markets work. So here's the bottom line. Are stock prices correlated across time? That is an easy question, of course. But the correlation actually varies depending on the time period you look at and depending on whether you're looking at daily, weekly, intraday, 6 month, 1 year, 5 years. You got positive correlation and some negative correlation other. You know what that implies, right? Essentially, at any given point when you look at markets, you're going to see people trading on momentum and you're going to see people trading on reversal at exactly the same time. Strategies coexist that seem contradictory, but they're trying to take advantage of differences depending on your time horizon. So as you look at all of these strategies, in general, at least the evidence seems to indicate that all of these strategies, whether it's momentum or reversal, work better if you have less liquid, higher growth, smaller cap companies than they do on larger cap, more liquid stocks. But the allure of trading is this correlation. And I think that we're far too quick to dismiss it sometimes as value investors and people that think that's irrational. There's nothing irrational about trading based on past prices. So we'll build on this theme in the next session by looking at technical analysis and charting indicators. But I hope you found this session useful, at least as an introductory session. Thank you very much for listening.